Welcome to another edition of Around the Table with Stacy Smith. Just when you thought it was safe to go back into the water, well, there are currents and they're swirling, and it looks like they want to try to drag investors down. When the markets closed on the night before Thanksgiving, investors were thankful for a good year so far, and it looked like the economic problems of the virus were now in the rearview mirror. But on Thanksgiving, word broke of another potentially lethal virus and the variant of that virus, and that, of course, sent the markets tumbling. From the day after Thanksgiving, through last Friday, the Nasdaq lost 4.75% of its value. For the Dow and the S&P 500, it was a loss of 3.4%. Now, besides the virus, there are concerns over inflation, and it was also a mixed unemployment report. So, to sort all of this out and its impact on how you invest, here is our outstanding group of advisors and strategists. I would like you to meet Carrie Coghill. Carrie is the president and CEO of Coghill Investment Strategies, which is headquartered here in Pittsburgh. She is recognized as one of the nation's leading voices on financial advising. As we go around the table, we find Frank Rossetti. Frank has been advising clients for 50 years. Frank helped to establish Harvest Financial here in Pittsburgh, where he is the executive chairman. Across the table, we find Kim Forrest. Kim is the chief investment officer and the founder of Boca Capital Partners. Kim has a dual background in both finance and software engineering, and you may have seen her in her many appearances on CNBC, Fox Business, and also Bloomberg. And the last panelist at the table is a name that's familiar to a lot of Pittsburghers, Bob Fragasso. Bob has been in the investment advisory business for nearly 50 years and is the chairman and chief executive officer of Fragasso Financial Advisors. So I want to thank all of you once again for joining us. The last time we spoke was just before Thanksgiving, before the market started to take a tumble. I'm going to ask each of you for your quick take on the markets and the reasons for that. But Kim, I'm going to begin with you. Now, at this point, it looks like the Dow, we're about midway through the trading day here on Monday, and the Dow is trying to make a recovery. It's up around 600 points. Is this just the market breathing right now with a big fall and the move back up again, or is there something deeper going on here?
I think there's always something deeper going on. The reason why I love my job is because I get to watch markets, and they tell you how people are thinking. Like, that's the best way to put it. So people move between fear and greed on a daily basis, but over the longer term, markets can give you big insights into the way we are changing our lives.
Frank, what's your quick take on this?
It's an interesting thing. It is always breathing. It's a living thing, and it is the cumulative knowledge of all of the participants, not just the five of us. And it's telling you, as Kim says, people are thinking about, and it's telling you that the economy and the world is much better than people want to talk about. There's a whole book about it I'll share with you one day.
Okay, Carrie, your thoughts.
Anytime you see the market have a sell-off, you really do have to dig deeper and say, okay, why is this happening? Now, we know that the new variant has something to do with this, but at the same time, we are at an inflection point, as I see it, with inflation. And when we look at the 10-year Treasury, which gives us some indication, it's definitely a factor that needs some digging. And it, in my quick opinion would really signify that we may have seen the peak potentially in inflation.
Oh, that's interesting. All right, Bob, your thoughts.
Well, I must caveat that predicting the future is inexact, and that this is just an opinion, not a prediction. We're natural movement of the market here. There's nothing fundamentally wrong. There are always questions in the market, but nothing fundamentally wrong that will cause a large sell-off.
All right. Kim, I'm going to go back to you. Is for your reasoning behind what you said, and I'll also ask this question for each of you. Is this what we yearly have, something called a Santa Claus rally taking place like on this Monday?
I think it's a little early to bring Santa into this. It usually happens about that from somewhere around the 15th on out. But I do think people are aware that the gloom and doom that pushed the market down, and probably more than a little bit of leverage, which always, kind of pushes the market around, was responsible for that quick downdraft. So I agree with a lot of the panelists that are saying things are better than we know. And I think that's what today's market is telling us.
What do you mean by leverage, Kim?
Oh, right. So you can either put money that you've earned and saved into the market, Or you can put a little bit of the money you've earned and saved into the market and actually use, credit. So here's the bad part about that. If you use credit, it can amplify your returns. We're not going to get into the whiteboard and math, but just trust us on this, that, you can, because you're going off the basis. You put 25% in, and, if it goes up 100%, that's a lot, right? But
Right.
Off of that 25%. Anyhow, back to the question. Whenever the market goes down, if your account falls below a certain point, you're going to be forced to either add money or sell that stock. Guess what usually happens? Sell that stock.
Okay, got it. All right, Frank, your reasons for how you feel it is.
I think as we moved into the weeks of the holidays, the participation in the market thins out a little bit. And the bids aren't quite as strong and the offers are not quite as strong. And there's just a little less participation, creating a little more volatility just because it's the holiday time and who's doing something besides paying attention.
All right. Carrie, you mentioned that you felt inflation has a deeper role in all of this.
Yes, I do. When we look at inflation, and this has been the story all year long with all of us discussing where we were with inflation, and you look at the components of that inflation, you actually look at the data, what we're seeing and what we're projecting, because inflation numbers are reported year over year, month over month. These numbers really suggest that as we go into next year, we're going to start to see those numbers come down a bit. And then when you dig deeper and you look at the core CPI or core inflation versus sticky inflation, which is the things that don't move as violently as food and energy, which are the components of core inflation, we have seen energy prices come down here a bit. So I really believe that when you look at the economic data, we potentially are entering into a time where we have growth accelerating and inflation decelerating, which is a very good time generally for stocks. Now, I know we're going to talk a little bit later about valuation, which factors into that, but we're really keeping our eyes right now on looking at portfolios to say, okay, what served us well during a period of rising interest rates? And now we have experienced a dramatic decline just in the last week in the 10-year treasury.
Basic note for you, then, you are optimistic.
I'm optimistic.
Okay. Another person who seemed to be optimistic is Bob. So give me your background on all of this.
Well, in deference to Santa, history is a guide, but not necessarily on cue.
All right.
All right. I agree with Carrie. There are things that we're facing, the COVID, the variants of COVID that we're anticipating with the Omicron coming around, and Delta is still a major force. We have trade imbalances. We have tensions with our adversaries, even with our trading partners. Those are all normal things. If we go back over the history of the markets, we're always going to have that buffeted, but there is nothing of a major nature that's going to cause an issue going forward. So I'm in Carrie's camp.
All right.
And I think Frank and Kim are too.
I would have to agree with you, given their analysis so far. So here's a quote for you. I wish they had never been invented. It's something we haven't talked about yet on this program, but that's from Charlie Munger, of Berkshire Hathaway, talking about cryptocurrencies. So Frank, I like your quick take on, do you agree with Charlie about cryptocurrencies?
Absolutely not. People resist change, and cryptocurrency, that magical thing that's happening out there, is really two things. It's partially the currency part, but in my mind, more importantly, it's the blockchain and the platform that makes it possible. And that platform, I believe, over the time of the next few years, is going to continue to evolve into something that totally transforms, not unlike the internet did. And this, by the way, is part of the internet. The way we do business, share information, keep our records, and own our assets. It's going to change things dramatically. I just wish I was 30 years younger so that I could witness it more fully.
All right, Carrie, your thoughts?
Well, we all know that cryptocurrencies are backed by blockchain, and blockchain is something that will transform many aspects of our lives going forward. However, when it comes to cryptocurrencies, there's no correlation to anything at this point. You know, looking at it as an asset, when the economy is growing or declining, what do cryptocurrencies do? We don't have that sense of correlation yet, nor do I believe that it's going to become a currency. I really look at it as maybe some kind of a commodity. And let's think about this. We as a community, we need to have regulation. And the whole idea of having a centralized currency is that if the economy needs to be stimulated, there are levers that can be pulled. If we have inflation, there are levers that can be pulled. If we did away with a centralized currency and lived in a cryptocurrency marketplace, I don't know what that would look like. It would probably look like the wild, wild west.
A little scary for you then.
Yes.
All right, Bob, your thoughts?
Yeah, you can't, I'm agreeing with both of you. You can't ban something. You can't put the genie back in the bottle. Cryptocurrency is here. Right now, however, it offers way too much risk in its current form for the serious investor. It's meant for people who want to take great risk, were willing to lose a lot of their money, and on the chance of making a lot of money. It's something to stay away from now as an investment vehicle, but as it becomes mainstream, it's going to be major as part of our international financing system.
Kim, would you agree with Bob? It's something to stay away from right now as far as an investing vehicle?
Absolutely. And maybe stay away from it forever. My issue is this: there's nothing that it represents. There is no underlying asset that it's attached to, at least not at this point. So I hate to say this, but even lottery tickets have more cash flow associated with it than Bitcoin. And it is like a lottery ticket without any pile of money to pay off. And that's my quick take on
All right.
cryptocurrency.
All right, Frank, I'll go back to you. You seem to be about the only one here in the panel that wants to embrace cryptocurrency right now.
Well, actually, I'm embracing blockchain. Cryptocurrency is not unlike the iPods that our children were using 30 years ago to listen to music. Steve Jobs at that time created a vehicle that he could do his R&D and get people to pay him to do it. And from that came all of what Apple has been doing, because 16-year-old and 14-year-old kids pushed it beyond imaginable limits. We don't do that with blockchain, but the young people today are. And the cryptocurrency is the vehicle, like the iPod, I think it was called, that pushed it with the music venues back at the beginning of the internet. And I think that the currency is, like everyone else has said, I'm not sure what it is, how it has value, and how it's going to be used. And as regulation, which they're working on, comes down, the volatility that it currently exhibits will decline dramatically, I expect. And one country has embraced one of the currencies, El Salvador, I believe, as their currency. And I'm not sure that's an indicator of anything significant, except that is one domino that has fallen so far. I don't believe that the currency will, in its current form, exist for long, but that form is likely to change as regulation pushes it one way or another.
Right now, Frank, if I'm not mistaken, China has outlawed it. I mean, they're saying no to this. Are they just waiting for some sort of way to figure this thing out so they can regulate it?
Absolutely. They have to be able to tax it and control it. And if we look back a few years ago, Italy and Greece and the pigs, they were called, Portugal, Italy, Greece, Spain, I can't remember who they all were. They were having difficulty managing their economy because they were all under the euro, which was a common currency. And they gave away their printing press. The media spends a lot of money these days talking about the printing press that the Fed is using to manipulate our currency and our economy. Italy and Greece and Germany don't have a printing press. It's the euro. It's controlled by a central unit. And that currency is very similar to what this is. It at least is backed by governments. This is backed by no one other than El Salvador. And I'm not sure that backing carries too much weight in the world economy.
All right, Carrie.
Yes, I think we really have to be clear on what is a cryptocurrency and what it was, or what the original purpose was. And the original purpose, there were many, but one was, this decentralization of being able to get the intermediaries out and just go direct. And I think that at some point, and I know that our government is looking into a digital dollar, which would technically be called a cryptocurrency, I guess you could say. But without any type of, as Kim said, without any type of backing of any kind. And people can say, well, the dollar's a piece of paper and it, it's not backed by gold anymore. So, does cryptocurrencies, do they actually become an asset of some kind? There's definitely potential for that. And it all surrounds the adoption of it. If people are willing to adopt it, you can create a market for it. There are an awful lot of risks. We as a company are not allowed to promote it, to sell it, or anything like that, because as we're dealing with other people's money, there's just not anything behind it. And like I said, for me personally, I'm wanting to think about this outside of the box, right? I really have to have an understanding of what the correlation would be to everything else. Otherwise, I can't fit it into a portfolio.
Okay, Bob, you already said it's something you would not advise your clients to invest in.
Right. It does not have a framework. Carrie said it earlier. There is no regulation. And we don't want over-regulation, but you want safety through reasonable regulation. Quick imagery. Have you ever seen where the television pieces where cryptocurrency is mined, quote unquote?
Mm-hmm.
It's a warehouse filled with racks with hundreds of PCs and some young people running those, eating up great gobs of electricity. Now, if you walked into a financial institution, whether it be an investment firm or a bank that looked like that, would you leave your money there? Would you invest your money there? That's not a context in which you want to place. Plus, in some parts, maybe large parts, you're swimming in a cesspool of people who are moving that currency around for nefarious reasons. I don't want any part of that.
All right, Kim, you kind of agree with Bob, right?
I absolutely do. Yeah. I brought up the fact that there is no asset that is conferred with you buying a Bitcoin or an Ether or whatever, Dogecoin, whatever you want. So that's my huge problem with it, because how do you value it? It's only based on supply and demand. Yeah, I get supply is constrained, but what can it do? The only way that I would begin to pay attention to it is if you could pay your taxes with it, because that says it's legal tender. Now, even at this point, I don't think it's good, because one of the definitions of money is a store of value. And I understand our Fed is trying to deflate our dollar by encouraging 2% inflation, which means today's dollar or tomorrow's dollar will buy 2% less than today. That's their goal. I understand that. But at least there's a governing body that says what it's doing and, has the bright hot light of everyone looking at it, which I don't know. I'm thinking more about cockroaches than, a Senate asking the Fed head questions, right? You can see cockroaches running out of Bitcoin. So I'm going to stay away from it, but I do watch it. And I agree completely with Frank regarding blockchain. It's important. It can solve a lot of problems that we have. And let's see where it goes. It's interesting.
So,
okay, go ahead.
If I could just interject to Frank's point about blockchain. Last week, I spent the week in Miami at Art Basel, which is one of the largest art shows in the world. And these NFTs, these non-fungible tokens, which are basically pieces of electronic art that utilize blockchain. They're amazing and real, and there's a really big market for it, and it's all based on blockchain. So
Okay.
And
the
to
world's
add one
moving
more
very
thing
fast.
before we leave this, to add one more thing, the blockchain, as I understand it, which should be underlined and capitalized because I barely understand it. But as I get it, I think the blockchain, as we migrate toward it, will help us with this cybersecurity problem we have, because it's very visible and very transparent, except nobody knows who's doing what, the way I understand it. And if that is true, we've got privacy that we don't have in our transactions today. And this may help with that as it evolves, which to me is a big deal.
Yeah.
Okay, good. We're talking about how cryptocurrencies may be, how do you necessarily judge the value, because they're not necessarily regulated. They're not necessarily tied to anything. So we're going to stay with Charlie Munger for a second, because we're going to flip it to this side. Another thing he said is that the stock valuations are even crazier, as he put it, now than they were in the 1990s. So Carrie, your quick take on what he had to say about that.
When we see headlines about stock valuations, it's really important to dig a little bit deeper, because this market has many stocks that have very high multiples, and the averages kind of get swayed with the big technology names that can cause distortion in the valuations. But when we dig deeper and we look at different companies, there are still companies that are trading within a very reasonable range of valuation historically. And then we have other companies that have had very high multiples. A lot of them have sold off tremendously. So as an investor, you want to make sure that you're looking at the actual companies that you own. Valuations in general, we have very low interest rates. That means that this market can sustain a higher level of valuation. The other thing that's a little bit different today is that when you look at the demand for publicly traded assets, the demand has gone up tremendously. So what that would tell me is that the historical data that we look back to, the 40s, 50s, 60s, the valuation numbers back then and the valuation numbers today, it seems as though they would be higher just purely because of the supply and demand that exists with more investors coming to the marketplace.
All right, Bob, your thoughts.
Well, Charlie Munger is a value investor and a Berkshire Hathaway, and as such are valuation averse. They want the cheapest possible security. So a statement like stock valuations, that's a generalization. Carrie hit it. Some stocks can carry a higher valuation. Other stocks have a lower valuation, and that's where you have to dig in. You can't make a global decision over it's too high, it's too low.
All right. Kim, your thoughts.
If I could have a sit down with Charlie Munger, I would tell him, look, Charlie, it's all relative. And, this is summing up what both Carrie and Bob have said, but it really is a different world today. There is the hugest thing is the discounting back using today's 10-year value, which is historically low. And that's what makes the world go around right now. So Charlie probably is looking at very discrete values where he said, if I've bought a stock at this amount, it's going to pay me back. And you have to throw that out of the window. It's all relative.
All right. Finally, we'll wrap it up with Frank.
I agree with what everyone is saying. And to just add a log to that fire, when you look at valuations today based on historical norms, you have to adjust historical norms to current events. Current events, as Carrie was saying earlier, we have a questionable inflationary environment today. Everybody's worried about inflation because the current number is high. Carrie explained very well how that might not be the case going forward. It may have maybe even peaked. if that is the case, and the 10-year Treasury is certainly telling us that, we're looking at low levels of inflation going forward. And if that is the case, we're looking at low interest rates going forward indefinitely, as I think Kim said a long time ago. And I think with that being said, the present value of future earnings will be higher just because the interest rate component of that calculation is low.
All right, good.
Stacy, could I reclaim just a few seconds of the 30 I didn't use? The valuations are not, as was just said, determined looking at a rearview mirror. You can't look that way. You have to look at earnings and free cash flow. If the free cash flow and the earnings of a company justify the valuation and you can grow into those, then it's worth it. And a quick anecdote, when Frank and I started in the business, Brunswick was selling for 99 times earnings. Remember? You know
Yes,
why? Because the conjecture was that we were all going to work a 4-day work week so we can spread the work out to more people who wanted to work. And so therefore they were going to go bowling. Now that's ludicrous, but that's a lot of the stuff that's going on when we make those generalizations. You have to get down into the metrics or it's just talk.
Okay, that's good. I like that one.
Just as an anecdote, I might not have bowled since Brunswick was trading.
I'll remember to place a bet if we go bowling together.
Exactly. Bob, I'm going to stay with you. A lot of companies, of course, are owned in this country. They're American stocks, but there are also quite a few stocks that are owned by foreign companies. So one company, Didi, is owned in China, but China is forcing that company to be delisted from the New York Stock Exchange. So, Bob, the question to you, your quick take on this. How careful should investors be about foreign-owned companies when they invest?
Once again, are we talking about, a rhetorical question, are we talking about China or are we talking about Great Britain? So a lot more caution in a country where there is risk beyond market risk. I have no trouble investing, once we've done the analysis, in companies in stable economies with stable governments. Right now, China is offering the investor risk that cannot be controlled. The tightened government control, you mentioned it in your lead into this question, tightened government control of business. The fact that we are at odds with the Chinese, that we have supply chain problems that may cause us to move away from China, all those things are risks beyond our control. I would be very careful, very leery of investing in China.
Kim?
But I have no trouble investing in the EU.
Okay, Kim, your quick thoughts.
Well, this is going to be kind of dull, but I'm going to throw it out there. Accounting matters. So you have to understand the rules of accounting. And I think my biggest problem with places like China and the developing world is their accounting rules don't match with our accounting rules. So when you're comparing two companies, one in America, one in China, could be apples and oranges. So I think buyer beware and look at what the accounting standards are. If you don't understand them, don't buy it.
All right, advice from there. How about your advice, Frank?
Stacy, I think that everybody is making great points, and some of the fundamental things that we take for granted in our country is specifically property rights. China has no property rights. India does. They don't have a court system, but they have property rights. And when you make investments, and we tend to look at international investments that need to be handled by mutual fund managers or managers who focus in that arena, because they will be familiar with the variations, such as Kim mentioned, with accounting, and be able to make those measurements much better than we can. However, I think that the long history of the international markets is they are growing faster than the United States. We are a mature economy. Southeast Asia is not. Africa is what do they call them? They're not emerging markets. They're even less far along than that. They are also commodity-driven economies often. And commodities are a major problem that the world has as we electrify, getting the rare earth metals and whatever we need to move in that direction. And some of these countries are going to benefit greatly. So I guess my nutshell is I am not at all opposed to international investing, although China is off limits.
Okay. Carrie, I hate to do this to you, but you got about 20 seconds here. Your quick
Okay,
thoughts.
no problem. I do think this delisting will cause people to take a step back because they don't like the carpet being pulled out from under them. And there's a lot here with China, particularly the privacy issues and so forth. So I do think that it's a proceed with caution, and more so for companies that wanted to list here that now may not.
All right, Carrie, thank you. We are about out of time. So Kim, I'm going to ask you to do this as quickly as you possibly can. You are the only one of our panelists who can make a stock selection, a pick for our viewers. So what is your pick this week?
So again, these are all, you have to look at your own portfolio and consider your own financial issues. But looking at the interest rate environment, which is very low, and seeing that the Fed is saying, we're probably going to begin, not buying as many bonds. And so interest rates will drift up. We're looking at financial services. So one of the ones we like is Morgan Stanley, the ticker is MS. And we think they're well positioned. They have a whole lot of fee revenue from trading, because not only are they a regular bank, but they do, facilitate trades and are a custodian. So take a look at that. Do your homework and make your own decision on Morgan Stanley.
Morgan Stanley is your choice for this week. Kim,
Yep.
Thank you. I also want to thank Bob and Frank and Carrie for joining us once again. And we'll see you probably in about a week or 2 weeks from now. Thanks again.
This has been a CBSN Pittsburgh special presentation. We now return to our scheduled programming in progress.